where then I said yesterday, I'll clean up this sequence for you guys a little bit better. That we're potentially seeing after we've seen this expanding triangle that we identified in one of our sessions, actually right before it actually ended, that we're potentially going to see a nice strong impulsive wave to the upside. That did happen. Sequence for you guys. You can also see that I've got a pitchfork here on my chart. Again, for those that are new to these sessions, I do like using market geometry as well, sort of a geometry to also find areas of angular support and resistance. I see that I'm having connection issues here. Sorry, guys. It's back again. No idea what's happening there, but is my... Can you guys still hear me? All right. Nathan?
Yes, I hear you.
Yep, sorry. It takes me about 5 seconds to click all the buttons I need to click to unmute myself. But yes, we are still hearing you.
No worries, sorry. I had a connection issue there, but I'm back now. All right. Anyways, sorry for that. Where was I? So I've been mentioning that we potentially now seeing something like this, all right? Where after this triangle or expanding triangle that we're seeing a third impulsive wave that's still moving to the upside. So this recent decline we've seen over here that started since last week, Friday, I believe, I'm still viewing as corrective. And as you can see, this little box, or this orange box that I drew here, I think this was on Wednesday, yesterday, was potentially an area that might act as support. Now, price has sort of tested it quite 2 times, 3 times, and it's trying to make its way back to the upside. So it could potentially be a very strong support area. Again, using market geometry, I kind of guide want to see how price closes or reacts to these market geometry levels. You see this dashed line that's sloping to the upside here. If we were to see a strong close below here, then we might see a deeper decline on the ES. But that being said, looking at our levels to lock, price has been below today's pivot point at 4,417. It reached S1, which is at 4,396. And like I said, it's been bouncing here, trying to get through this angular median line that we have up here, right in that box that we drew yesterday. So potentially a very strong area of support. We don't have a session tomorrow. We'll obviously recap things on Monday again and see if we can start seeing another move back to the upside again. Again, I'm still viewing this, whatever this is, as corrective in nature, whether it's over or not. We'll just have to wait and see, obviously. So I'm still expecting higher prices on the years. Then the NASDAQ, similar thing, also have a pitchfork that I've had on my chart here for the longest time. As you can see, price has been bouncing between these median and lines pretty well. They've been acting as resistance and support as well pretty well. And then same thing as the ES, the NQ start moving lower. It gave us a bit more of a nice zigzag sort of pattern. And it did bust through this lower median line over here, but it did find support, actually fell short of today's S1 at 40,935, and it's now trying to make its way above today's pivot point, which is, I can't see that label now, about 15,104. You see price nearly reached today's projected range high. I think it's like a couple of ticks away from there at 15,186. So that might be acting as resistance currently. But similar thing as on the ES, I'm treating this as corrective in nature and expecting in the long run higher prices for the NQ as well. YM, similar thing as on the ES, I drew this box in here. When was this? Yesterday, because we didn't have a session on Monday with a public holiday, and also reckon that we could find or see YM find support at that level. We actually have a confluence between this median line and today's S1, which is at 34,150, 141, 140, somewhere around there. So also been testing it 3 times, similar to what the ES been doing and trying to make its way higher. Similar to the ES, hitting this area. If price were to strongly close below this area, we might start seeing a deeper decline on the Dow as well. But it's sort of been bouncing between today's S1. On the current candle, on the 4-hour candle, it just reached today's pivot point at 34,264. So it's sort of like bouncing in between there. I'd really like to start seeing a nice impulsive move back to the upside. Maybe on a smaller time frame, we'll look at that on all of these markets on Monday. maybe look at a 30-minute, 1 hour chart, or maybe even smaller, to see if we can start seeing a 5-wave sequence for the upside, which might mean that support's actually stepped in and we might see the YM head back to new highs. We have the Russell, obviously way weaker than the ES, NASDAQ, and the YM, obviously a different market or different indice, but also a really cool example for those that's been following my analysis here for a while. Obviously, if you've been following the Russell, it's been stuck in a really sort of whippy and quite large trading range since mid-March. And we had this breakout out of that range beginning of this month, and that sort of gave the direction or the idea that price will continue higher, drew in this pitchfork. I've used this setting, which is a modified pitchfork this time around, just because of how price basically reacted, found resistance over there. Actually overshot this area over here, what we call our upper red warning line. But quite often, if you have areas where price overshoots one of these areas, you just draw a ray or a trend line or whatever you want to use parallel to one of these lines and project it from one of those areas, in this case where it overshot that line, and it acted as resistance once, twice, 3 times, and then we start seeing a move downwards again. So yeah, difficult to say what's happening here on the Russell. Not as impulsive as obviously the ES and NASDAQ and the YM. That being said, it was sort of riding or hugging this upper median line up until today, where price actually opened below today's pivot point at 1,880 and has since declined pretty strongly. Busted through S1 and it just reached S2, which is at 1857.4. So trying to make its way back up again. And this is a very good example of what I'm saying about, you know, you see price sort of testing an area of angular support, in this case, upper median line. If it then breaks that, then you can expect a deeper decline. Quite often, if price doesn't make it to another median line, you quite often get a retest. So if price were to move back up again, it might now this time around find resistance at this upper median line and maybe give us another move down to the downside again. All right, and that brings us to gold. Just a quick update for those that are new here. We're following this 5-wave sequence in real time during these profit at noon sessions, and we've also identified back around beginning of March towards the beginning of April, we had this triangle formation. We also tracked live in during these sessions. Price made a move back to the upside, and we labeled this as a 1, 2, 3, 4, 5. We had that big spike to the upside, also had this upward sloping channel. Price just tried to get above that channel, and I marked this as a 5th wave and start seeing a decline. And we mentioned at that stage, if price were to break below this channel, we're probably going to see a deeper decline. So that did occur. Now the real question is, are we correcting lower? Was this sort of like in a bigger picture end of a very strong top, and we're going to see a bit more of a bearish market? And gold, that I can't tell you. Obviously, anything can happen in markets, but if we're looking at a sequence to the downside, I'm kind of still thinking that this first move to the downside of a correction or a start of a much large bearish trend is maybe getting close to its first leg to the downside. If this is going to be, let's say, a correction, it could be an A, a B, and a C, or it could be a 1, a 2, and a 3 to the downside. So I'm pretty bearish on gold, but that being said, expecting a potential bounce to the upside anytime soon. All right, so from our levels to locks perspective, price has opened below today's pivot point at 1941.1, reached S1, busted through that, and just fell short of today's projected range low, which is at 1922.9, I believe. So this angles or these trend lines I've drawn in here, it does look to me that since this high around about the beginning of this month, that price might be moving lower in some sort of an ending diagonal. But I'm seeing this ending diagonal as the potential end of this first decline that we've been tracking during our profit at noon sessions. So do expect potential bounce higher in gold to retrace potentially a deeper portion or decent portion of this initial decline, but expecting a larger or deeper decline towards the end of the year. That being said, obviously anything can change at any time, and as long as things do follow these projections and all these markets for that matter, I'll just stick to it until obviously things do change. Right, and that brings us to crude oil. Same thing here in crude oil. We've been tracking crude oil obviously as well. We had this 5-way sequence to the upside in crude oil. I mentioned that this was probably part of an expanded flat. We had a strong decline towards the beginning of May. It just put this previous low that was formed towards the end or mid-March actually, and then we start seeing the sideways gyration here. So a pretty large range here in crude oil. Not really following my market geometry. So for the next session, I'm going to start getting rid of all of these lines. It did follow it pretty well until this area here where the Saudis said that they're actually going to, you know, halt production of crude oil. Markets went bananas and then immediately had a reversal lower again. So a pretty large range that crude oil is stuck in. I'm still thinking that what we're seeing here could potentially be a triangle. I was saying yesterday, watch out for a potential move towards 61.8, maybe the 78.6. And if we do see a break down to the downside, and which we obviously got, and price then fails to take out this low and find support around, let's say, the 61.8, which is around today's second deviation projected range low, which is around about the same area, 69.16, 69.18. If price should find support, let's say between 61.8 or 78.6 and bounces higher again, then I think the probability of that triangle idea would start making more sense, if that actually makes sense to you guys. But yeah, very messy market at the moment, very volatile, but still have that triangle idea in the back of my mind. So it could definitely still be a possibility for crude oil. So still thinking crude oil can move lower at some stage. So if this is a triangle, we'll obviously know when it actually gets confirmed after an E wave and price starts breaking these lows again, that it would potentially just lead to another further decline for new lows in, for this year. So watch out for the 61.8 and that 78.6 area. Within that area for potential bounce back to the upside. Alternative price just breaks down and moves much lower, then something else is going on. But yeah, that's pretty much the analysis side of from my side. Again, not much has changed since yesterday. And yeah, if you guys got any questions, please feel free to ask. Otherwise, I'll hand over the reins to Brian from Equity Sciences.
Hello, guys. How you guys doing this evening? Doing all right, Richard?
Yeah, good in yourself. Nice meeting you.
Likewise. I appreciate Nathan and Richard for having me on. Before I get started, let me...
Very excited to have you, Brian. So everybody give us a warm, we'll imagine we're hearing it in the stadium now, the raucous applause. Give everybody a hand for Brian Miller of Equity Sciences. He's got a lot of excellent stuff to show you here. Like a mad scientist working away in his lab. This is going to be excellent. So we're very excited, Brian. Take us away.
There we go. I appreciate that. Before we get started, read off a disclaimer. Historical performance, whether live or simulated, may not be indicative of future results. Trading stocks, ETFs, futures, or FX involves significant risks that may not be suitable for every investor. Investors should only choose to invest funds they can afford to lose without negatively impacting lifestyle. Price characteristics are not predictable or repetitive, thus any strategy developed from historical data will be equally unpredictable. We do not guarantee nor claim our strategy will be performed positively and or reflect our historical results. In fact, there can be significant differences between historical and live results. Please consult your investment professional before choosing and trading an investment strategy to ensure it meets your investment objectives and risk tolerances. All results shown are historically simulated, not live real. All information and data presented is my personal opinion, as I am not an investment advisor, thus do not consider investment advice, nor solicitation of any individual product, service, and or equity. All right, so again, my name is Brian Miller. I'm the head strategist for Equity Sciences. I'll try to keep this, hit the high points. I'm a self-confessed data nerd, so I have a bad habit of diving a little bit too deep into the weeds. So, today is, we'll review some of the primary strategic concepts. Obviously one of our main products, SPY, and the concepts, philosophies, some of the systematic structures and such that we deploy. But everything with us starts with our process. So Let me see. There we go. So, everything that we pursue at Equity Sciences is dependent on data and the characteristics that data exudes. For instance, we don't design a strategy and then apply that strategy across every market type. So instead, we align and customize our concepts. While the underlying strategic concepts may be similar, they're tuned to each asset's characteristics, because some assets just have completely different characteristics. Like, for instance, QQQ is more momentum driven than, let's say, RSP or SPY, which is the S&P or equally weighted S&P. And there's fundamental justifications for that. The NASDAQ is more singularly focused from a sector perspective or industry perspective, whereas the SPY and RSP is more diversified when it comes to the sectors within it. So, our strategic result and objectives, what are we wanting to accomplish with the concept? Who is it serving? Who is it designed for? And then also the risks therein. So designing condition-specific alpha and smart beta sources. Everything that we pursue is really designed to integrate and magnify the benefits of diversification. So we are wanting to diversify the factors that produce outcome. And how we do that essentially is through a method that we employ called market classification. And technically, every strategy that someone may design, that's what you're doing. You're classifying the market into some form of repetitive condition. However, our application is slightly different. And that structure allows us to implement, layered intellect in highly adaptive structures within, our entry logic, exit logic, and our allocation, which is, it's a significant part that's overlooked within the quantitative R&D space. Across the quant landscape, there's a significant amount of resources that are allocated to sourcing alpha. However, we view that just as, one part of the engine. It's just, for an automobile, it's just the engine. You still need the steering wheel, the transmission and the fuel tank, right? So, there are additional systematic structures that can still be integrated to still nurture positive outcome whenever trying to mitigate a lot of the associated risks that are, again, associated with either the market, the asset, and or quantitative models in general. And then we can also tune those strategic concepts for specific outcome goals and or to the asset's characteristics. And everything that we try to pursue is a kind of a symbiotic relationship between the asset's organic characteristics, the strategic concepts, and then how those are tuned for specific performance objectives. And application versatility is a part of that. And what I mean by that is, let's see. So here is a similar concept, but it's tuned completely differently. So it's essentially the same framework. It's the same systematic framework, but as you can see, it's 4 completely different applications of that framework. It's tuned and customized 4 completely different ways, right? And so that's one benefit of market classification, is its application versatility. So it gives you the ability to really match what you're trying to accomplish. And not only that, but the types of value that are best to be exploited within that asset. And so, market classification is essentially using proprietary, analytics. We break the market down into 64 repetitive market environments and substructures. Now, some of those, environments are more dominant than others. Some of them, may occur for more extended periods of time. Some of them are more short in duration, but they occur at a much more frequent rate, right? And so what we then do is we take those, those classifications, and then we'll research to find what are the optimal variations of value to be exploited within within that classification historically. And so everything that we pursue is a value-based perspective. So value meaning like not so much fundamental value, but quantitative or technical value, right? So, everything that we pursue as far as value is also multifactorial, meaning multi-perspective, multi-frequency. So we're wanting to look at value from as many perspectives as possible. And then that determines what type of logic it is that we're trying to apply. So, those value-based entry logic combined with value-based allocation helps mitigate the risks of being heavily allocated near recent pivotal or cyclical highs. And the additional structure of market classification allows for an extremely high level of adaptability, even in strongly bearish or systemic risk environments, the ability to be long only, but to still nurture positive outcome. And I will show you what I mean by that. Here's an example of classification, right? So this is just a basic indicator of market classification, and it outputs a single number, right? And so this is just a generic example, but so, using, whatever analytics that we want to pursue, we classify the market, and that is different across various markets. So that is another level of diversification that we want to integrate strategically, conceptually. So we really want to magnify as many perspectives of diversification that we can across the board. And so even, long only has kind of a bad rep within the quantitative space, but whenever specific strategic concepts and systematic structures are combined, that's really not applicable to these types of frameworks, because those are all about, long and short funds are all about outcome diversification. So you can exploit, multiple price directions. And so what we're wanting to do with, multi-alpha or multi-value is just attack that diversification in a different way. And so, is someone playing music in the background? Okay, there we go. All right, so what we're wanting to do is pursue, value diversification. So this is a perfect example of that. So, within this classification structure, we're essentially identifying, okay, within this type of market environment and substructure, we're wanting to deploy, value source A, B, or C. In some conditions or some classifications, we can actually exploit multiple variations of value. And so value to us is random, reverting, consolidation, cyclic, oversold. And then some of those are, are kind of scaled, right, from a strength perspective, like from a 1 to 10. And so what I mean by that is some environments you may be able to exploit, consolidation and reverting, or random and reverting. And, the type of value that we're wanting to exploit there is all dynamic. So all the values that we seek to apply are dynamic. Nothing is set. So we don't deploy, set logic. And to us, that's kind of like, throwing a stone in the river and expecting it to mimic its flow, right? So we want to apply, creatively simple strategic concepts, however, wrapped within highly adaptive, systematic or quantitative frameworks, right? And so keeping aligned with John Conway's works on rules and complexities. And so if you see, obviously this is long only, but if you can see the performance graph, let me make sure that you can see that. Yeah, you can. Okay. Yeah, if you can see the performance graph, this is open position equity. You can see in this period, these multi-value concepts essentially are designed to exploit volatility and multi-perspectives of value, right? And so, that's the main process behind, we're seeking to exploit essentially the same fundamental, the same behavioral justifications that traditionalists have been, preaching and pursuing since the dawn of modern portfolio theory. However, we want to exploit it in a more effective manner, right? More efficient manner. And how we do that is, identifying the market condition, a repetitive classification essentially, and then simply applying the type of value that's best to be exploited within that. Now that's the entry perspective, right? And then you have additional entries, which is also a similar logic. So we want initial entry within each position, additional entry, and all that is dynamic as well. And then comes the allocation perspective. So, you can, with a highly adaptive allocation logic that doesn't even identify, optimal entry targets, with value-based allocation logic that, dynamically increase the allocation based off the type of value that the market is presenting. Just some of those concepts alone can be very consistent historically, average well over 15 to 20%, depending how aggressive some of the customizations are, using very basic value identifiers, meaning like close is less than open or low is less than yesterday's low. And if those two conditional statements are true, then it will allow an entry. And the only dynamic value that's applied is an output ratio that measures value. And so whenever we look at value, we are measuring that from multiple perspectives. So we're wanting to look at that, from multiple high points on multiple frequencies. And so we're not just looking at, okay, well, what is the close from the highest high, last week's highest high, or what is the close minus pivot high, right? We want to look at that over multiple frequencies, multiple types of measurements, because value is very subjective, for one. And then also we found that, the more that you can eliminate singularities, the better. And actually, before we even began our work, that is one of the primary risk factors to consistent outcome longevity, is when outcome is heavily dependent on some perspective of singularity, meaning a single variation of value is exploited or a single source of alpha. Your outcome is heavily dependent on a single market environment or a single condition, right? Or a single entry, right? So the more that you can eliminate singularities from determining outcome, and the more that you can integrate diversification, the more likelihood you can integrate, adaptive structures to increase the probability of positive outcome on a per position basis. And whenever that compounds over time, you can see a pretty consistent result from that, using creatively simple but highly adaptive structures, right? And so so whenever we're looking at highs, we're looking at multiple points, and then we're ratioing that out over a set length of time. And then when you're using multiple perspectives of that, for instance, like if you're exploiting reverting or random types of value in this type of condition, you're only deploying maybe 2 or 3% of capital. Whereas, down here, more cyclic or consolidation variation of value, maybe on a per entry perspective, you're deploying 8, 9, or 10% of an allocation. So everything is dynamic, and that can adjust intra-position, that can adjust from condition to condition. So it doesn't matter what, for instance, these entries up here were probably 2 or 3%, anywhere from 1 to 4%. These down here were probably anywhere from 4% to 8%, right? And so that helps bottom weight positions, because the market has the highest risk from wherever it is, from wherever the price currently is. So, the way that we kind of look at value is the deeper, it's kind of like, things being on sale, so to speak, right? You want to buy more when things are on sale than when they're not on sale. And it's a very simple concept. It's a very simple methodology. It's just wrapped within highly adaptive frameworks, right? So, and another thing that you see the chart is very busy, right? It's not very selective, right? But it's and there's a reason for that. One, we want to increase data points throughout the model historically, and that it can reduce the risk of overfitting, and it also allows us to more quickly identify whenever the model is performing deviated out of its norm, so to speak. And so this model has out of sample since the beginning of 2019, essentially. So about right and through here. So from this point forward is all out of sample. Let me show you what that is on the open equity. Let's see. Yeah. So about right and through this area right here, from this point forward is all out of sample. And so in a market condition like 2022, hedge funds, 2022 was the worst year for hedge funds since like 2018. And so, and that's even, for funds that could go long and short. So one could argue that multifactorial value-based quantitative models are even a more ideal source of outcome diversification than long and short, because you're not going against long-term fundamental and behavioral biases, right? And so, the S&P 500, I think it was approximately -18, -19%, something like that for 2022. Had a maximum drawdown of approximately -23, -24%. And this model produced approximately 22.1% of return in 2022. And the maximum drawdown on that would have been, I believe, around 13%. So less risk, higher, approximately 40% alpha. Now, the other benefit of that is, historically speaking, although the model looks very busy, very active, and it is, we still maintain about a percent time in market of about 50. Our models typically, historically, and this is, multiple markets, just not this specific product, anywhere from 40 to 60%. So, we're only in the market approximately 40 to 60% of the time. This particular model is approximately 53, 55%. In high volatile conditions, we tend to be a little bit more active. So 2022, that percentage was probably closer to like 70 or 75%. But the other risk perspective that we seek to mitigate is not just how, what percent of time, capital is at risk, but what percentage of your capital is at risk. So because all of our models are multi-entry, our percent of allocation is per position basis is pretty low. It's, it could be around 30 to anywhere from 25 to 40%. So approximately 50% of the time you don't have a position at all. So you're highly liquid. And then when you do have an open position, you're only using the majority of time anyway, anywhere from 30 to 40%. Now, the model can be heavily allocated at times, and what I consider heavily allocated is anything above 80%. That can happen in some extreme conditions, some extreme value conditions where the model tends to compound its position. But in those types of scenarios, that's the reason why it's important to deploy adaptive exit logic as well. And that is both from a positional profit target perspective and a per entry profit target. And so as you can see, let me see if I can. There we go. All right. So as you can see, this would be a positional based exit, whereas these down here would be a per entry, right? And so it's important whenever these concepts are assimilated and deployed, that you deploy multiple methods that nurture positive outcomes. So we want to deploy per entry based profit targets as well as per positional. And the closed position return generated from those per entry can mitigate your open position risk that you might be holding from, position 1, position 2, or position 3. So whenever you're looking at your open, your open equity, it just helps nurture, higher outcome consistency, and it can also reduce the risk profile, because now you've secured a certain amount of profit, and now you have that capital to redeploy. Now, all of our models deploy compounding allocation. So the 22 percent, technically, if you started trading and if you activated this in like 2019 moving forward, your ROI would be much higher than 22%. The 22% was actually CARG. So so our models deploy, a compounding allocation, and that's another benefit to trade frequency. So the more quickly your model trades, the more frequently your model can compound and reinvest that return back into its allocation structure. So you don't have to seek very large percent, profits on a per entry or per position basis to generate, a high level of growth, a high level of consistency, and all that can be adaptive and dynamic and relative to the characteristics and condition that the asset is exuding, right? And so you can see from an execution perspective, that is 2022, here's 2021, bull market, and in COVID, this model generated approximately 20%. It was approximately 20% return. Had the max drawdown in the COVID year was even less. It was only like 6.5%. So let me see if I can show you periodicals. There we go. Yeah. So 2020 was 21%. So very good. The profit factor on these overall historically is 6.6, about almost 2,000 trades, around 80, a little over 84%. The maximum drawdown, now this was starting with hypothetically $100,000 investment. In the first straight trade was executed in 1997, and we always use as most, a maximum amount of data as possible when designing these models. We're not a company that only uses from, 2009 forward that you might see with some products, or 2016 forward like you might see with some products. We want to include as much data as possible. However, we don't go, or we don't use data, or heavily weight it, I should say, anything before 1997. And the reason for that is you saw a pretty considerate shift in market characteristics around that time due to market access and internet, impacting the markets. So you saw, that's the reason why, strategic, very simple, strategies that worked pre-1997, don't really work anymore. And that's one of the reasons for it. So, so there's a benefit to using data before that, just as maybe just a secondary confirmation to say, hey, if these conditions occur again, will it perform well? Okay, yeah or not. But it's not, as far as determining model values or anything like that, it's not heavily weighted. And so we typically go back. We don't pursue markets with market data that at least does not include the financial crash of 2008, 2009. We at least want to include that within our model development, within our testing processes, to ensure that we can, have enough data points, within our model execution, as well as to, effectively, be able to classify, these conditions on a repetitive basis, to where it's just not. Now, we want to closely fit everything, but there's a very, there's a fine line between closely fitting and being, logical with, how you're aligning the concept to a condition, and only using data for a short amount of time that can be easily skewed, right? And so that's another reason why we want to include as much data as possible. But this would be your open equity for approximately 25 plus years or so. And this would be your closed equity. So, and another factor there that we look at is the deviation between those two factors. Not only do we want to mitigate time between new equity highs, but we also want to mitigate the differences as much as we possibly can between your open and closed performance. So we try to design concepts that really try to nurture as much as we possibly can consistency while still outperforming. And so on a initial capital perspective, if you would have bought the S&P 500, 25 plus years ago at the same period where this model first executed its first position, it would have generated approximately 552 or 553% return, whereas our model on an ROI basis would have generated 2,740%. So pretty significant difference there. And not only the growth profile, but also the risk profile. So, over that time, you're maintaining, let's see, is it at? Yeah, percent time in market, approximately a 53% time in market, and the percent of allocation that's actually activated, because as you can see, a lot of times we want to be as efficient as we possibly can with our first entry, right? So we would just prefer most of the time just to be in and out with a single entry, but we realize that one of the risk factors for quantitative models is randomness. So randomness, conditional sequencing. And so no matter how intelligent, how adaptive, how robust your alpha sources or beta sources may be, they're always going to come times or periods when they're out of sync with the market for whatever reason, right? So, we want to have, multiple thoroughbreds in the stable, so to speak, right? And so that's another reason for multiple entries. But as you can see, in and out with a single entry. So even when you see a lot of activity, a lot of that can just be 1, 2, or 3 entries, and the amount of capital deployed on those, is maybe, depending on the condition, anywhere, and the level of value that's identified using 2 types of analytics: 1, market classification, and then 2, multifactorial value ratio. Combining those to output what percentage that we should apply to that entry, which if you strip, and that's another reason for intelligent allocation is, we kind of view multiple entries, like if you would strip allowing multiple entries, the single entry models would still be, consistent on their own. So allowing multiple entries, intelligent allocation, adaptive exit logic on a per entry and per position basis, all those are what we think of as kind of like safety net structures, right? Structures that we don't want to be the justification for positive outcome, but we want to be there to nurture positive outcome in the instance that something is out of sync. Maybe there's one of the analytics that we use within our classification structure, maybe it's lagging for whatever reason, right? And so we want to integrate structures that nurture positive outcome on a per position basis, and then compound that probability improvement over time, right? And so let's show a good, healthy amount of conditions so you can get a good perspective on how the models perform in different environments. And so here's a good example of, the first and second entry wasn't very efficient there at identifying, the type of value that we exploited. The market was in an overbought condition, but so we held on to that drawdown, which is a small percentage. So it looks bad because you're holding on to it, but the percentage of allocated there maybe been 2 or 3, maybe 4%, whereas the allocations down here would have been, significantly higher because it's a more type of consolidation or cyclic type of value, right? And so this is another benefit of per entry based profit target. So the model enters here, and then within the same day, it exits and secures some profitability with a level of allocation that's higher than these 2 entries combined. So now you're already positive compared to, their open position drawdown of a peer because the allocation was higher. So everything else after that is, icing on the cake. So that's another benefit of per entry based profit targets. And again, all those are highly adaptive. So that was 2018. Let's show you 2015, 2016. You can see there how the market performs. And again, there's a lot of benefits to multiple entry. One, it allows you to deploy an intelligent and adaptive allocation. Two, it allows you to diversify the types of value that you're trying to exploit, not just but intra-model, but intra-position. And so you can, essentially you're finding, it allows you to integrate, and magnify the benefits of diversification on a per asset basis. When you look across the investment landscape, it doesn't matter which type of fund, whether it's quantitative, traditional, value, momentum, it doesn't matter. They all deploy diversification. However, not many deploy it intra-asset, right? So they may allocate a lot of resources to a single source of alpha, and then trade that single source. And then when the rate of our environment that we live in, our reality is evolving at such a fast rate that, those nuanced alpha sources can fall out of sync with the market very quickly, right? And so that's another thing that we don't deploy. We don't pursue nuanced sources of alpha. We keep our underlying strategic concepts very simple. And we don't use machine learning to source alpha either. And the reason for that is whenever you're deploying like deep learning AI, it's practically impossible to identify the real strategic risks or the conceptual risks of the strategy or model that you're deploying, because that AI is likely highly adaptive and you can't explain why it's choosing a certain pathway, right? So it would be impossible to know what the real risks are of that concept. Instead, we deploy, creatively simple strategic concepts in, dynamic and adaptive frameworks, and then we'll create some internal analytics that may allow it to internally analyze itself, internally analyze performance to create kind of like a constant pressure of improvement per se. But as far as, relying on nuanced alpha and chasing the sexy new thing, quote unquote, of nuanced alpha and machine learning and AI and all that, we don't go down that. So we don't pursue those paths, nor we pursue, quote unquote, the sexy new, stock on the street. So we stick with large cap, blue chip, boring, index and sector ETFs, very boring, stocks. A lot of large cap blue chip dividend, a lot of consumer staples, Walmart, AT&T, things of that nature. And actually, now we prefer ETFs because they're diversified entities, so they have more reverting characteristics. So they tend to work very well with our concepts because of that. Stocks are more singular in nature, so they pose obviously a higher risk profile. But I will say, out of all the stocks, what does work very well with value and reverting based concepts is AT&T. AT&T is a phenomenal asset for value and reverting concepts, especially if it's multi-value and if you can exploit a diverse array of value variations. AT&T is a wonderful asset for that. One of the reasons obviously is they're the large cap blue chip, but they deploy their dividend used to be, almost 7.75%. I think they've reduced it a little bit recently, but still yet. So there's some fundamental and behavioral justifications for why that occurs, for why those reverting behaviors occur. And so when it comes to individual stocks, we want to choose and pursue stocks that have that detached from their correlation during systemic risk environments. So it's one of the kind of a game theory application that we deploy within our analytics, which is slightly different than our applications with ETFs, right? And so let's show you 2009 again. So as you can see, 2008, volatile year in 2007, very higher consolidation pattern after a bull market. And then here is the market going back to like 2000, 2001, 2002, 2003. So you can see we're still very active in all these bearish conditions. It's just the type of value that we're wanting to exploit adapts to the condition. Not only that, but the allocation that we're applying adapts to the type of value that's presented. And so, it's very simple. It's keeping aligned with the same the same philosophical approaches that traditional products, methodologies, pathways have pursued for a very, very long time. It's just that we want to increase the level of adaptability and our level of diversification. So it's very simple. It could be kind of complex when you start talking about the justifications or the underlying structures and concepts, but you as a client don't really need to know any of that. We offer our products in signal service format. It's very simple to deploy. The signal is delivered to you via email, which is, let me see if I can show that to you. So this is our website, equitysciences.com. This is our homepage. You have you have index and portfolio packages, and then you have SPY, and then you have a special offer. You go to a special offer, and right now we're actually running a special that if you sign up for 6 months, you get a discount. You can sign up for monthly if you prefer, and that's whichever is best for you, or you can sign up for 6 months. We offer you a discount, and either one. We also offer an indicator, and the indicator is a market classification indicator. So it'll apply using whatever analytics we pre-program with some various analytics for you to, and that works with any strategy. So you can classify the market however you want to using the analytics that we've included. And then you can identify, if you deploy a certain strategy of your own, a discretionary strategy, you can say, hey, I want to see what classifications my strategy works best in. So then you can take that classification structure within the analytic and test that across the board to see historically across 10, 15, 20, 25 years of data, what classifications are best with your discretionary strategy. And then you can choose, hey, I'll use that as a filtering methodology moving forward on a discretionary basis. So I'll only deploy this strategy when it's in classification 32, 33, 13, 4, and 1, whatever those might be. And so that gives you a very precise filtering mechanism to deploy it, to integrate. That's very basic. It's very simple. It's not really increasing risks of overfitting necessarily. It's just trying to apply an additional layer of intellect to whatever your discretionary processes may be. And so, but from a product perspective, we deliver everything in an email format. It's very, very simple to follow. We give you the entry price, the allocation percentage. And again, that's another thing. We can't just deliver a number of shares because everyone is starting with a different amount. So we just deploy a percentage, and whatever that percentage is what you deployed on the per entry perspective, right? But it's good to have a visual so you can see why we deploy multiple entries and why we might scale out of some positions with a per entry profit target, and how those structures all work in unison to increase the overall outcome consistency. But, Equity Sciences, if you have any questions, probably dove a little bit too deep. I was really trying to just hit the high points. I'm sorry if I nerded out on you, but Equity Sciences, we have index and portfolio packages. And so, the equity index package right now, it just has QQQ and IWM. We will be looking to add a couple of markets to that. We'll be looking to add DIA and MDY to that as well. And so, that way it kind of be a complete index package. And so you're getting pretty much the basics there. And so from a SPY perspective, it's one of the most popular markets for multiple reasons. And even if you don't deploy the strategy as a whole, there's a couple of different ways to integrate that within even a discretionary process. So for instance, even if you want to trade like a smaller time frame, even you can know what percentage allocation, and because it's multi-value, the percentage output of allocation can be a signal to follow. On a discretionary method, relative, hey, when this model is 80% allocated, I know it's very deep value. Or when it's 2% allocated, I know to trade this frequency, right? So there's a lot of ways to integrate that, even if you prefer to trade options, right? So even if you can take those signals and then just open up whatever options that you prefer to pursue. But there's a lot of ways to integrate the signal, whether it's just following the signal and trading the asset, or integrating it in another way within your discretionary processes. So a lot of value there that we're offering for the cost, as these are designed essentially as to serve to replace a lot of traditional methodologies in a lot of ways. So, but that's the basics. Again, our philosophical concepts are all about mitigating a lot of the risks that are associated with the markets, and as well as quantitative models, and all of the structures that we've designed ultimately are there to nurture an increased rate of outcome consistency. And so how we accomplish that is in a creatively simple format. It can be a little challenging to, if you're not familiar with the sector, with the lingo of quants, it can be a little challenging to understand the details. But again, clients don't need to know all the whys, right? Or the hows, and how we get there. Just a basic understanding of a value-based quantitative model, and some of the basic principles that we tend to follow within our processes. But that's it for me, guys. I appreciate your time, Nathan, for having me on. It's been fantastic. If there's any questions, by all means.
Sure.
Yeah,
absolutely. Well, thank you so much, first of all, Brian, for your time, for being here with us, and for all the valuable insights and the sneak peek you've showed us into the lab, the mad scientist, as I've dubbed you. Awesome stuff. Just really blown away. So glad you're able to come here and join us for this. I do have a question coming from over on YouTube, and this will be helpful too. I know we had a few folks that joined late, but Bob wanted to know, is this an automated system? Is it fully hands-off?
Yeah, it's quantitative. Yeah, it's but as a signal, that could be that's just deployed obviously on a discretionary basis. But we are setting up strategic partnerships where these could be deployed on an automated basis. So we're actually working with a company right now to set that up for clients that do prefer to be completely hands-off and just deploy this on a 100% automated basis.
Fantastic. So that's in the works. And then, Bob, if that's something you are interested in, fully hands-off, it is something they're working on. That sounds like it's just around the corner. So we have made that link available in the chat here in Zoom, as well as the chat over on our simulcast on YouTube. Definitely encourage you to check that out. Grab onto that link. Don't lose it. Definitely check it out here today. I really want to thank you again, Brian, just for coming in here, making that available to us and to the Ninjacators crowd. So we're very blessed to have you. But if you have any other questions here for Brian before we wrap up here today, we're going to go in just a few minutes. But of course, we're going to make plenty of time for anything that could be on your mind. So if you want to pick his brain, you had any questions about what we've shared with you here today, we'll be happy to take care of that for you on the way out the door.
Yeah, if they have any questions, if they want to contact me, you can reach out to me. I'm on LinkedIn, or Brian, that's with an I, at optimizedtrading.com, or my business partner, Robert at optimizedtrading.com. So feel free to reach out anytime. We have an open door policy. No matter, if you're curious about a product or if you lease a product, we really seek to offer the same level of quality on the customer service side that we do on the product quality side. So anytime you have any questions, feel free to reach out.
Fantastic. Yes. And in my dealings with both you and Robert thus far, it's just been a pleasure. So as Brian mentioned, if you have any questions after we get out of here, if something pops into your mind, just head over to their website. They have their contact information readily available there, and they will be happy to take care of that for you. But we're giving you an opportunity here before we got out the door. I see Richard did point out Scott had a question for us when he came in late, just in case anybody didn't see that there in the chat. Two-parter. There will be a recording available. So if you were late or if you just jumped in and you need to catch up, on our YouTube channel, youtube.com/Ninjacators. This recording will be available as soon as the broadcast concludes. It is currently still broadcasting live over on our YouTube, but there is a playlist for all the Profits at Noon sessions. Obviously, you're going to be looking for this latest session, and it does include Equity Sciences in the title, that there are special guest presenters here today. So if you're on the lookout for that recording, you want to revisit any of this material, just head over to our YouTube as soon as this concludes. We will also make that link available. And the second part of Scott's question as to whether or not this was a strategy or a package that's available to the Ninjacators crowd. Yes, this link, grab this link. They have prepared a special offer available to all of the Ninjacators crowd here today. So definitely check that out. Awesome. Well, it looks like we don't have any more questions coming through just this moment, but we'll give you just one more minute if anything's popping into your brain there. And then, of course, we'll check in really quickly with Richard. I see, Richard, you're still here with us. Richard, if you had any thoughts here on this awesome presentation that Brian shared with us today.
Sorry, I sure am. Awesome presentation. Thanks, guys, for joining today. Yeah, always great to delve into this quantitative sort of trading stuff. Way above my head, to be honest, but it's you can see on the equity curve that it obviously works. So you guys definitely put a lot of work into that. So really, really cool stuff. Great to see. Hopefully have you guys back with us again at some stage.
Yeah, absolutely. So we're actually we're planning on launching a couple of other products as well within futures. So the really cool thing about some of these too is they translate over to futures. So whenever you design some of these concepts, you may have to make subtle adjustments for the differences in price characteristics, differences in leverage, and things of that nature. So some of the allocation logic is tuned differently, but other than that, strategically, conceptually, they translate over very well to futures markets, specifically micro futures. So
perfect.
Yeah. So we'll be offering
our crowd excited.
That's absolutely. Yeah.
Excellent.
We actually have another product launching soon that'll be it's a short frequency product. So it's applied to a small time frame, very high trade frequency, very high engagement. So we're very excited about that one. So we have a few products that are kind of right around the bend.
Fantastic. Awesome. Well, we look forward to seeing those roll out, and then of course the opportunity to have you back here to share with us and our audience. We'd love for that opportunity.
Yeah, absolutely. Appreciate it, guys. Thank you so much for your time.
Absolutely.
Thanks,
yeah.
Brian.
Thank you again, Brian. And I know I believe Robert's here with us in the chat or in the background as well. Thank you both, Brian and Robert, for being here with us today. And to all of you who joined us, as always, our audience here in Zoom and over on YouTube, thank you guys and gals so much for being with us. Again, just want to mention this really quickly for you as we head out the door. The replay of today's session will be available on the Ninjacators YouTube immediately upon conclusion of this broadcast. We will make this link available to you. I'm going to go ahead and fire that away in the chat one more time, just so it's on everybody's radar. This link will also be attached to the replay recording over on YouTube. Definitely do not take this for granted. Take advantage of what Brian has shared with us here today and what he's brought to the table for our audience. That said, we will be back next week on Monday. I know for a reason you were back with us here on YouTube. It's great to have you here. I think I mentioned to you in the chat, we were out Monday for the holiday, so your tool spotlight is still on deck for next week. We're hoping you can make it. If you have any questions or requests for our future sessions after we get out of here, as always, head over to the Ninjacators website. You can contact us via email, or there's a phone number plastered all over that website if you need to get in touch quick. One of our customer service ninjas will be more than happy to take care of that for you. But all that said, until then, everybody just have a great weekend, and we'll see you back on Monday with a fresh set of levels to lock, and we will keep you posted on when we can bring our friends from Equity Sciences back into the house. So thank you again, everybody. We're all waving if our cameras were on. We're waving as the bus drives away.
Absolutely.
Thanks, everyone. Thanks for attending.
Appreciate it, guys.
Have a
good
great
one.
weekend.
Awesome. Thanks.
too.
Thanks, Hal. You have a great weekend
Cheers.
too,
Bye-bye.
Hal. All right. Awesome.
Have a
Thanks,
good one.
Brian.
Bye-bye.
Richard, goodbye, everybody. Have a great one.
See ya.
Cheers.